If you have ever felt like the world of investing speaks a different language, you are not imagining it. Financial content is full of terms that get used as if everyone already knows what they mean, when in reality, most people were never taught any of this at school, and nobody sat down and explained it clearly. Today, we are going to fix that. 10 investing concepts, explained in plain English, in the order that actually makes sense. By the end of this video, you will have the foundation that most investors spend years trying to piece together from different sources. Let's start at the beginning. Concept 1. Compound interest. Compound interest is the most important concept in all of personal finance. Not the most exciting, not the most complicated, the most important. And the reason most people never fully grasp it is that it is slow and invisible in the early years, and then suddenly, almost shockingly powerful in the later years. Here is the core idea. When you invest money, you earn a return on that money. Simple enough. But compound interest means you also earn a return on the return, and then a return on that return, and so on, indefinitely, for as long as the investment runs. The growth does not just add up, it multiplies. And the multiplying effect accelerates over time. Let's put some real numbers on this because the abstract explanation misses the point. You invest £10,000 in a global equity index fund, earning 7% per year. In year 1, your £10,000 generates £700 in returns. Now you have £10,700. In year 2, the 7% return is calculated not on 10,000, but on 10,700, giving you £749. The following year, it compounds again on the new, larger total. By year 10, your £10,000 has grown to approximately £19,600. You have not added a single extra pound. Time did the work. By year 20, that same £10,000 has grown to approximately £38,700. By year 30, it is approximately £76,000. The same £10,000, the same 7% per year, has produced 7.5 times the original investment over 30 years without a single additional contribution. Now here is the part that makes the concept genuinely life-changing. The reason compound interest is most powerful for people who start early is not simply that they have more time. It is that the biggest gains happen in the final years of the compounding period, not the early ones. In the first 10 years of our example, the £10,000 grew by £9,600. In the final 10 years of the 30-year journey, it grew by £37,300. More than 3 times as much growth in the last decade as in the first. This means that someone who starts investing at 25 and stops at 35, having contributed for only 10 years, will often end up with more than someone who starts at 35 and contributes for 30 years until they retire, assuming the same monthly amount. That is not a typo. Starting 10 years earlier, even with a shorter contribution period, produces more wealth because of the extra time the compounding effect has to run. The practical lesson is simple. The most powerful investment decision you will ever make is the decision to start. Not to start perfectly. Not to start with the right amount or the right fund or the right market conditions. Just to start. Every year of delay is a year of compounding you will never recover. And every year of compounding you give your money is a gift that grows in value the longer you keep giving it. Concept 2. Diversification is the practice of spreading your investments across multiple assets so that no single failure can destroy your entire portfolio. It is the closest thing to a free lunch that investing has to offer, and it is why the simplest investing strategy available, owning a global index fund, is also one of the most sophisticated. The core principle comes from a simple observation about risk. If you put all of your money into a single company and that company goes bankrupt, you lose everything. If you put your money into 10 companies and one goes bankrupt, you lose 10% of your money while the other 9 continue to perform. If you put your money into 1,000 companies spread across dozens of countries and sectors, and several of them fail in a given year, the impact on your overall portfolio is minimal because the others absorb it. This is not just theory. It is the mechanism that makes long-term investing survivable through the kinds of events that look terrifying at the time. When a specific technology company implodes, the diversified investor barely notices. When a particular sector has a terrible year, the diversified investor sees it in a small part of their portfolio, but not in the whole. When one country's economy struggles, the diversified investor has exposure to dozens of other countries that are not struggling at the same time. The key insight about diversification is that it reduces risk without necessarily reducing expected returns. A portfolio of 1,000 global companies is not expected to return less than a portfolio of one company. It is expected to return similarly on average, but with dramatically less volatility. You give up the possibility of getting very lucky with a single spectacular winner, but you also eliminate the possibility of getting very unlucky with a single catastrophic loser. And in investing, avoiding catastrophic losses is more important than chasing spectacular gains, because losses compound against you just as gains compound for you. There are 2 important nuances to understand about diversification. The first is that it does not protect you from broad market declines. When global markets fall, as they do periodically, a globally diversified portfolio falls too. Diversification protects you from specific failures, not from the general movement of markets. The second nuance is that diversification requires the assets you hold to be genuinely uncorrelated. Owning 10 different UK banks feels diversified but is not, because all 10 banks tend to move in the same direction at the same time. True diversification means owning different types of assets in different sectors in different countries, ideally assets that tend not to all fall at the same time. Concept 3. Risk versus reward. Every investment involves a trade-off between the potential return you can earn and the risk you take on to earn it. This relationship is not accidental. It is the fundamental mechanism through which investment markets function. And understanding it properly changes the way you think about every investment decision you will ever make. The basic principle is this: safe investments deliver low returns. Risky investments offer the potential for high returns. This is not a design flaw. It is the reason people are willing to make risky investments at all. If a risky investment offered the same return as a safe one, nobody rational would choose the risky option. The higher potential return is the compensation the market offers for accepting the higher risk. Cash in a savings account is the safest investment most people make. It has almost no risk of nominal loss, meaning the number in your account will not go down. But the return is low, typically close to or below the rate of inflation, meaning the real value of that cash is gradually declining. Government bonds are slightly riskier than cash, but safer than shares, and they offer a higher return than cash as compensation for that additional risk. Shares in publicly listed companies are riskier still because the company can underperform or fail, and in exchange they offer a higher long-run expected return than both cash and bonds. Shares in small or emerging market companies are riskier than shares in large, established companies, and they offer an even higher long-run expected return as compensation. The key word in all of this is expected. The higher return from riskier assets is not guaranteed. It is the average outcome over long periods. In any given year, shares can fall dramatically. In any given decade, they can underperform bonds or even cash. The long-run higher return from equities materializes over periods of 20 years or more, not over 1 or 2 years. This is why your investment time horizon is the single most important factor in deciding how much risk to take. If you need your money in 2 years, high-risk investments are genuinely dangerous because you might need to sell at exactly the wrong moment. If you are investing for 30 years, the short-term volatility of high-risk assets is largely irrelevant because you have the time to wait for the long-run return to materialize. Concept 4. Stocks. A stock, also called a share or an equity, represents a unit of ownership in a company. When a company wants to raise money to grow its business, one way it can do this is by selling shares of itself to investors through a process called an initial public offering, or IPO. Once those shares are listed on a stock exchange, investors can buy and sell them freely. When you own a share in a company, you own a proportional slice of everything that company owns and everything it earns. If the company is worth £1 billion and you own 1/millionth of the shares, your stake is worth £1,000. If the company grows and becomes worth £2 billion, your stake is worth £2,000. If the company shrinks, your stake is worth less. And if the company fails entirely and goes into administration, your stake can become worthless. Companies that are profitable sometimes return money to shareholders through a payment called a dividend. A dividend is a share of the company's profits paid out to shareholders on a regular basis, typically quarterly or twice a year. Some companies pay generous and consistent dividends. Others reinvest all of their profits back into growth and pay no dividend at all. As an investor, you receive returns from shares in 2 ways. Capital growth, which is the increase in the value of the share over time, and dividend income, which is the cash returned to you by the company from its profits. The return from owning shares over the long run has historically been higher than the return from any other mainstream asset class. The ftse 100 has delivered approximately 8 to 10% per year, including dividends over multi-decade periods, and global equity indices have delivered similar returns. But those returns come with significant short-term volatility. Shares can fall 30, 40, or even 50% in severe downturns before recovering. The investor who understands this in advance and accepts it as the normal cost of long-term ownership is the investor who actually captures those long-run returns. The investor who panics and sells during a downturn locks in the loss and misses the recovery. It is also worth understanding the difference between owning individual shares and owning shares through a fund. Buying individual shares in specific companies concentrates your risk. If you buy shares in 5 companies and one fails, you lose 20% of your equity portfolio. Buying shares through a broadly diversified index fund, which might hold 3,000 companies simultaneously, means the failure of any single company barely registers in your overall return. For most individual investors, owning shares through a diversified fund rather than through individual stock picks is both simpler and produces better long-run outcomes. Concept 5. Bonds. A bond is a loan that an investor makes to a borrower, typically either a government or a large company, in exchange for regular interest payments and the return of the original amount at a specified future date. If you buy a 10-year government bond with a face value of £1,000 and a coupon rate of 4%, you will receive £40 per year in interest for 10 years and then £1,000 returned to you at the end of the 10 years. Bonds are generally considered less risky than shares because the borrower has a legal obligation to make the interest payments and return the principal. If a company fails to pay its bondholders, that is an event of default, which is a serious legal matter that triggers the insolvency process. Shareholders, by contrast, have no such legal claim. They are owners of a piece of the company, and if the company fails, they are last in line to receive anything from whatever is left after all the debts are paid. The price of bonds moves inversely to interest rates, and this is one of the most important and most commonly misunderstood aspects of bond investing. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. The reason is straightforward. If interest rates rise and new bonds are issued with higher coupon rates, existing bonds with lower coupon rates become less attractive, and their price falls to compensate. If you need to sell a bond before it matures, you sell it at the current market price, which may be higher or lower than what you paid, depending on how interest rates have moved. In a balanced investment portfolio, bonds typically serve two purposes. They provide a more stable source of income than shares, and they tend to move in the opposite direction to shares during periods of market stress, meaning they can provide a cushion when share prices fall. The proportion of bonds in a portfolio typically increases as the investor gets older and needs more stability and less volatility in their returns. Not all bonds carry the same level of risk. Government bonds issued by financially stable governments, such as the UK, the US, or Germany, are considered very low risk because the probability of those governments defaulting on their debt is very low. These are often called gilts in the UK context. Corporate bonds, issued by companies, carry more risk than government bonds because companies are more likely to default than stable governments. And the risk varies enormously from a bond issued by a blue-chip company like Unilever to one issued by a small, highly indebted business. The higher the risk of default, the higher the interest rate the borrower must offer to attract investors, which is why riskier corporate bonds are sometimes called high-yield bonds. Concept 6. ETFs and index funds. An ETF, which stands for Exchange Traded Fund, and an index fund are closely related investment vehicles that both allow you to own a diversified slice of many assets through a single purchase. Understanding these two tools is arguably the most practically useful thing you can take from this entire video. An index fund is a fund that tracks a specific market index. A market index is a list of companies selected according to specific rules. The ftse 100, for example, is an index of the 100 largest companies listed on the London Stock Exchange. The S&P 500 is an index of the 500 largest companies listed on American stock exchanges. An index fund that tracks the ftse 100 holds all 100 companies in the same proportions as the index, and its performance mirrors the performance of the index. When the index rises, the fund rises. When the index falls, the fund falls. The critical advantage of index funds over actively managed funds is cost. An actively managed fund employs a team of analysts and fund managers who research companies and try to select the ones that will outperform the market. This research and management costs money, and that cost is passed on to investors through the fund's annual management charge. Active fund charges typically run from 0.5% to 1.5% per year or more. An index fund, by contrast, simply tracks the index mechanically. It does not need an expensive research team. Its annual charges can be as low as 0.05 to 0.2% per year. An ETF is structurally similar to an index fund but is listed on a stock exchange and can be bought and sold throughout the trading day just like a share. Index funds are typically priced once per day after the market closes. For most long-term investors, this difference is irrelevant, but it means ETFs offer slightly more flexibility. In the UK, the most commonly used ETFs for long-term investing include the Vanguard ftse All-World UCITS ETF, which tracks over 3,000 companies across 49 countries. and the iShares Quorum World ETF, which covers approximately 1,500 companies across 23 developed markets. Both carry annual charges of around 0.2%, making them among the most cost-efficient investment vehicles available to UK investors. The overwhelming body of academic and industry evidence shows that over any period of 10 years or more, the vast majority of actively managed funds underperform the index they are measured against after fees. This is why the global investment community has moved decisively toward index fund investing over the past 2 decades, and why a simple globally diversified index fund inside a stocks and shares ISA is the starting point that most independent financial advisors recommend for long-term wealth building. Concept 7. Liquidity. Liquidity refers to how quickly and easily an asset can be converted into cash without significantly affecting its price. It is a concept that most people never think about when markets are calm, and then suddenly care about very deeply when they need their money and cannot access it. Cash is the most liquid asset of all. It is already cash. You can spend it immediately, transfer it, or withdraw it without any process or delay. A current account at a bank is essentially as liquid as cash itself. A savings account is slightly less liquid because there may be a notice period for withdrawals, but for most practical purposes it is still very liquid. A government bond can be sold in minutes on the open market at a price close to its current value. A share in a large publicly listed company can be sold within seconds during trading hours. These are all highly liquid assets. Property is significantly less liquid. To sell a house and convert it into cash typically takes 3 to 6 months in the UK, involves estate agents, solicitors, surveys, and considerable transaction costs. If you need money urgently and your only asset is a house, you cannot access that money quickly without potentially selling at a significant discount or taking on debt against the property. A business interest is even less liquid in many cases, particularly in a small private company where finding a buyer can take years. The reason liquidity matters for investors is that it affects the choices available to you when circumstances change. An investor who holds all of their wealth in illiquid assets, such as property and business interests, may be asset-rich but cash-poor. They cannot respond quickly to opportunities. They cannot cover an unexpected emergency without a complex and time-consuming process. They may be forced to sell at the wrong time or at an unfavorable price simply because they need cash and have no liquid assets to draw from. The practical implication of this concept is that a well-designed personal financial plan includes a meaningful allocation to liquid assets, most importantly, an emergency fund in an easy-access savings account, alongside the longer-term, less liquid investments. The liquidity of your portfolio should match the likely timing of your needs. Money you might need within a year should be in liquid assets. Money you will not need for 20 years can be in less liquid ones. Concept 8. Inflation. Inflation is the rate at which the general level of prices in an economy rises over time. It is measured in the UK primarily through the Consumer Prices Index, or CPI, which tracks the prices of a representative basket of goods and services bought by households. When inflation is 3% per year, the same basket of goods that cost £100 last year costs £103 this year. Inflation matters profoundly for investors because it is the benchmark against which all investment returns must be measured. A return of 5% sounds impressive in isolation. But if inflation is 4%, your real return, which is the return above inflation, is only 1%. Your purchasing power, which is what ultimately matters in terms of what your money can buy you, has increased by only 1%. And if inflation is higher than your investment return, your real purchasing power has actually decreased even though the number in your account has gone up. This is the mechanism through which cash savings lose value in real terms even when the nominal balance is unchanged. If your savings account pays 2% interest and inflation is 4%, the number in your account grows by 2%. But the cost of everything you might want to buy has grown by 4%. Your money buys less. You are effectively 2% poorer in real terms at the end of the year, despite having saved diligently. Over long periods of time, the compounding effect of inflation on purchasing power is dramatic. Assuming 3% annual inflation, £100,000 in today's money will have the purchasing power of only approximately £74,000 in 10 years, £54,000 in 20 years, and £41,000 in 30 years. This is why holding large amounts of money in cash over the long term is one of the most reliable ways to destroy wealth in real terms. The assets that have historically provided the best protection against inflation are shares in real businesses, which can raise their prices as inflation rises and tend to generate earnings that grow with the economy, and property, whose value also tends to rise with general price levels over time. Bonds, particularly fixed-rate government bonds, are poor inflation protectors because the interest payments are fixed in nominal terms and therefore erode in real terms as inflation rises. Concept 9. Pound cost averaging. Pound cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing at the time. Rather than trying to time the market by investing a large sum when prices seem low and holding back when prices seem high, you simply invest the same fixed amount every month or every quarter, automatically, without trying to second-guess the direction of the market. The mathematical mechanism behind pound cost averaging is straightforward. When prices are high, your fixed investment buys fewer units of the fund or shares you are purchasing. When prices are low, the same fixed amount buys more units. Over time, this means your average cost per unit is lower than the average price of the unit during the period, because you automatically buy more when prices are low and less when prices are high. This is a genuinely useful mathematical property that works in your favor without requiring any active decision-making. But the most important benefit of pound cost averaging is not mathematical. It is psychological. The biggest single threat to long-term investment returns is not market volatility. It is investor behavior during market volatility. Research consistently shows that individual investors dramatically underperform the funds they invest in because they tend to buy after markets have risen, feeling confident, and sell after markets have fallen, feeling frightened. This is precisely the opposite of rational investment behavior, and it destroys wealth reliably and repeatably across millions of investors. Pound cost averaging short-circuits this tendency by removing the decision from the equation. You invest on the same day every month, regardless of whether markets are up or down. You never have to decide whether now is a good time to invest, because you have already decided that every month is the time to invest. In practical terms, pound cost averaging is what happens naturally when you make regular contributions to a workplace pension or a stocks and shares ISA by direct debit. You are investing a fixed amount each month without thinking about it. The market goes up and down, and your contributions continue regardless. Over a working lifetime of 30 or 40 years, this disciplined and automatic approach to investing is one of the most powerful wealth-building habits available to any ordinary person. Concept 10. Market capitalization. Market capitalization, almost always shortened to market cap, is the total value that the stock market assigns to a company. It is calculated by multiplying the current price of a single share by the total number of shares the company has issued. If a company has 1 billion shares outstanding and each share is priced at £5, the market cap of that company is £5 billion. Market cap is the primary way the investment world categorizes companies by size, and understanding this categorization helps you understand how different funds and indices are constructed and what you are actually buying when you invest in them. In the UK, companies are broadly divided into large caps, which are the biggest companies typically included in the FTSE 100, mid-caps, which are medium-sized companies typically included in the FTSE 250, and small caps, which are the smaller listed companies. Globally, the same distinction applies, with the world's largest companies measured in hundreds of billions of pounds in market cap and small caps measured in millions. The significance of market cap for investors goes beyond categorization. Different sizes of company tend to behave differently as investments. Large cap companies, such as the major banks, energy companies, consumer goods businesses, and pharmaceutical companies that dominate the FTSE 100 are typically more stable, more liquid, more likely to pay dividends, and less volatile than smaller companies. They are well researched, well understood, and their share prices reflect a large amount of publicly available information. Small cap companies tend to be less researched, less liquid, more volatile, and capable of both larger gains and larger losses than their larger counterparts. Over very long periods, smaller companies have historically produced higher returns than larger ones, a phenomenon known as the small cap premium, but they have done so with significantly higher volatility and risk. Index funds are typically weighted by market capitalization, meaning that larger companies make up a larger proportion of the fund. In a FTSE 100 index fund, the biggest companies by market cap have the greatest influence on the fund's performance. This means that a small number of very large companies can have an outsized effect on what appears to be a broadly diversified portfolio. Understanding this helps you interpret what you own and why your portfolio moves the way it does when specific large companies or sectors have exceptional years or difficult ones. Those are the 10 concepts that form the foundation of intelligent investing. You do not need to master all of them before you start. But having a working understanding of each one will make every investing decision you make from this point forward a more informed and more confident one. If this video gave you a clearer picture of how the world of investing actually works, please hit the like button and subscribe to UK Finance with Peter for more straight-talking content on money and investing for people living and working in Britain. Thanks for watching, and I will see you in the next one.